Hello, everyone. I hope your week's going well. Welcome back to another webinar. Today, we're going to be talking about where to save for your child's future. There's a few different choices out there to pick from, and they all have their own pros and cons. So today, we're going to talk about each one of those different options that you have to pick from and give you a ranking as far as which one I think is the most important to start with, and maybe one or two that you want to try to avoid if you can. So first off, why do we want to look at these different options? As I mentioned, there are pros and cons to each of the different choices to pick from. Some of them have really good tax benefits that you can take advantage of, or ways to offload your tax bill and move it on to your child's tax bill, which is usually very low. So different strategies that we want to consider when setting up a plan for your child's future and make sure we follow those rules. So really today we're going to just dive into more details on that and make sure that you have a good understanding of where each account fits within a financial plan. So the first account that I wanted to talk about today is going to be either UTMA or UGMA accounts. Some people call them UTMAs or UGMAs, and they're very similar between the two. The difference is that an UTMA is only used for, or sorry, the UTMA is used for anything. You can even have real estate involved in an UTMA, where UGMA, UGMA is only going to be for traditional investments such as like stocks and bonds and mutual funds, ETFs, things like that, where you would have the money invested within an institution. So that's what we see people doing most often. So how do these accounts work? The first thing you know is that when you make a contribution to this type of account, it's an irrevocable gift. So you're gifting the money to your child, and the money is now in your child's name. So what this means is that when your child reaches full ownership age, which is around 18 or 21, it depends on what state you're in. California, for example, is 18. At that point, the money is completely owned by your child, and you have no more control over those assets. So this is an important piece, and often why I see that people don't do these plans is they're not necessarily 100% sure they want to gift this money irrevocably to their child. They want to see how things play out, right? Make sure they're going to be a good kid and whatnot. And when they want the child to be able to have control of this money, even if they know they want to give it to them, maybe they don't want them to have ownership control of the money until they're 25. And doing this type of account, you can't select the age that they get access to the money. So that's the negative. The positive is that they're very easy to use, easy to open, and you can just invest it however you want. The biggest con being that control of the account. The only other thing to mention with these accounts and why people even do them in the first place is that when you have the investments inside the account growing, because they're in the child's name and they're the child's assets, you actually get to use your child's tax brackets for the gains in the account. However, there are rules. It's called the kiddie tax, which basically means that it's not unlimited amount of money that can be taxed at the child's tax rate. It's only a certain amount, which I believe for 2026 is going to be around $2,300 of gains that has this special rule. Above that, the gains go back to being taxed at the parent's tax rate. So you really just get the first $2,300 of gains get special tax treatment. Everything else is basically the same as if the money was yours, is going to be paying your tax rates and whatever they come out to. The second option that you have to pick from is going to be a 529 plan. These ones are the most common, and most people know about these because they are college specific plans. And the way that these work is very similar to a Roth IRA. So if you remember from previous webinars, a Roth IRA, you put the money in, it grows tax-free, and then you get to take it out tax-free later on. So the 529 plan works the same way. So it has really good tax benefits. However, if you do not use the money for education costs, then you're going to have to take the money out at not only taxes paid on the gains, but also a 10% penalty on the entire amount of the distribution. So you really only want to be putting enough money into the 529 plan that you know you're most likely going to be spending on college. oftentimes our clients don't put all their eggs in this one basket. They'll put a certain amount of money into a 529 plan and a certain amount of money into one of these other options, just so that they make sure they avoid that penalty. Now, luckily for these plans, there are more rules these days as far as ways that you can get out of the penalty. So, number one, if your child receives a scholarship, you can take out the entire scholarship value from the 529 plan without having to pay a penalty. You still do have to pay the capital gains tax on the earnings that you got from that money, but there's no penalty. So, it's similar to if you just invested it outside of the 529 plan, which is good. And the other option that's available that's relatively new is using the money to move it from the 529 plan into a Roth IRA for your child. So now your child didn't use all the college funds. You get to put that money into a retirement plan that they get to benefit from. There are limits on that right now. So it's around 36,000 is the lifetime limit of the 529 to Roth IRA transfer that you can do. And basically the way it works is that you do the yearly Roth IRA maximum. So for 2026, that's $7,500 a year. So you would do $7,500 a year of transfers from 529 into Roth until you've hit that $36,000 limit for your child. But that is a nice way where you can avoid paying taxes and paying the 10% penalty and moving that money into a Roth IRA to help set up your child for success. So the next option available is setting up a brokerage account. This is just a taxable investment account with no tax perks. It's just your regular old investment account and keeping it in your name. So yes, you're going to have the tax consequences associated with the gains in this account. There's no tax benefits. It's just like any other type of brokerage account that you might have set up. A lot of our clients will set up two. They'll have one that's for themselves that they're keeping track of, and then one that they can set up for their child that we just nickname it like for child's name. And that way you can just have the money separated mentally and know that this account is set up specifically for that child to invest. And the nice part about this is that you maintain complete control. We're nicknaming the account for your child's name, but it's not theirs, it's yours. So we can always take that money back and use it if you need it for your retirement plan or you have a major medical emergency or unexpected expense and you need that money, you can access it. Or you can just gift it to your child later on whenever you want to, and you get to decide on that. There are gift tax rules and things to think about here, but the gift tax lifetime exclusion is like $11 million per person. So it's not really something that you have to worry about as far as gifting this large lump sum of money to your child. You're not really going to get to that threshold where we have to worry about owing taxes for gifting money to your child. Not really an issue, but just some loopholes and things that you need to pay attention when you're doing a large gift like that. But besides some paperwork, no extra taxes involved there. As I mentioned, the cons is that no tax benefits. It's going to be taxed at your income tax rates or capital gains tax rates, depending on how long you're invested. The positives is you maintain complete control of this money. So the last option is going to be a minor Roth IRA. And so what this is, you're just setting up a retirement account for your child. You're setting up the Roth IRA right from the get-go. The issue with this account and why I put it as number 4 here is that you have to have income to contribute to a Roth IRA. So what some of our clients do is they have their child working and their child's earning income, but then they gift the money that the child's putting into the Roth IRA. So the child doesn't actually have to put their own money into the account. They can use money that you gift them, but they have to have earned income to be able to add to this account. So they have to make at least $7,500 a year if you want to max out the plan. And you can just give them the 7,500, or you could just put it straight into the account for them to max it out. But they do have to have a job and earn income. For all you freelancers out there, there is the opportunity to hire them and do part-time work for you. They do actually have to be doing work and doing something to earn this money, But that could be a whole tax benefit loophole strategy for you where your child's working for you, you're giving them money that you would have basically given them anyways, but now it's a tax write-off. And then that money that you give them even more money toward their Roth IRA to set them up for retirement because now they have earned income that they can use. So there's a lot of different ways that you can involve this Roth IRA, hiring your child strategy to get a bunch of different tax benefits here, but that is an important piece of the plan. Now, as far as using this for your child's future, there are ways to access this money. So you can always take out the money that you put in yourself completely tax and penalty free. So you're taking out your basis. The only issue you have to worry about is actually the earnings in your account. So let's say that you're socking away all this money for your child into the Roth IRA. You're doing this $7,500 a year, and they get to college and you want to use some of this money for college. Any amount that you have put into that plan, you could take back out to pay for their college. But any of the growth you got along the way, you have to leave that there unless you want to pay tax and a 10% penalty. So there is ways to access this money. They can also take $10,000 for a first-time home buyer's deduction from this account. So again, there are these different rules and stipulations to use the money earlier, but it's not as flexible as something like the parental brokerage account. So here's a head-to-head comparison of the different options. If you're watching this archived after the fact, you can pause here and review all these different options and see the pros and cons laid out against each other to see what's going to be the best fit. But the main thing here is that there's not one size fits all plan. Usually I don't see people doing all of these options. Usually they're doing one or two, but you can figure out what's going to be best for your situation. And just to give you an example of how this might look, I have here like a court reporter with a 12-year-old child, and let's say you have $300 a month that you want to invest for your child's future. Maybe we commit $200 a month toward the 529 plan, but we don't want to put all of our eggs in that basket. So you set up a brokerage account in your name that you add another $100 a month into. And maybe that's to buy their car in the next few years, their first car or wedding or first down payment, or you end up just using it for college anyways. But again, you keep that flexibility there. And then if you want, you can always do one-off contributions for them into a Roth IRA, or even setting up something like the UTMA or UGMA account. And small gifts is really what I would limit this to. Grandparents wanting to add money here for their grandchild's birthday every year, things like that, where they're going to get the money in the future and they don't have to use it for college. That could be a good option. So if I was to rank these strategies in order of priority, for most people, the 529 plan is going to be the go-to option to start with. The main reason being is that college is going to be inevitable for most, or if not trade school, you can use it for court reporting school, you can use it for different professional certifications. So it's not just for college only. Anything that you're doing to certify yourself or educate yourself can potentially be used for the 529 plan. So there's a lot of flexibility there. Also, if you're planning to send your child to private high school or even elementary school, they can use that money up to $10,000 per year to cover those expenses as well. So there's lots of opportunities to use this money on education. And there's the way to add it to the Roth IRA as a backup plan or take the money out from the scholarship deduction. Outside of that, I like the brokerage account option, keeping control and flexibility for you. And you can decide when you give them this money, if you give it to them at all, and you keep the most control and flexibility. Roth IRA and the UTMA or UGMA are lowest on the list. We rarely open up an UTMA or an UGMA just because it is a big commitment doing an irrevocable gift to your child, knowing that they're going to get this money as soon as age 18 to be able to do whatever they want with it. Not too many people are doing that option. So as far as your action plan from today's webinar, number one, define what your goal is. What do we want to just plan for college, or do we want to do more to set your child up for success? What type of control do you want to maintain over these assets? And that might help point you in the right direction. I would start with one account and then add as you go on. We don't need to open four different accounts at the same time and do $50 a month to each of them. That's just way too much complexity for no reason. So start with one and then you can always add on later and layer those in over time as you want to add more options into your plan. If you do have any questions, as always, you can leave a question in the comments, or if it's to your personal situation, you can shoot me an email, or we can set up a time to discuss your individual situation and talk about working together to help manage this for you. Most of my court reporter clients could figure all this stuff out on their own, but the reality is you got jobs during the daytime and then you got proofreading at night and managing the business side of things along with spending time with your family. So having someone like me take this stuff over is just one less thing that you have to worry about. So that's all for today's webinar, and I'll see you all next time.